Welcome to the Daily Shareholder Brief. I'm your host, Sunil Joshi. Today is February 17, and in the next 10 focus minutes, we will walk through a few corporate developments that matter most to individual investors. We will cover US, European, and Asian companies with respect to their earnings, regulatory decisions, strategic shifts, and capital allocation, with an emphasis on what's changed and why it matters for shareholders. This program is for informational purposes only and is not an investment advice. Always do your own research and consider your individual financial situation before making any investment decisions. Today, we will be reviewing six companies that have been in the news recently: Warner Brothers Discovery, Kraft Heinz, McDonald's, Hapag-Lloyd, Siemens Energy, and Alibaba. Let's start with our first company, Warner Brothers Discovery. Warner Brothers Discovery has been in the headlines recently as strategic discussions around potential takeovers have intensified. Shares currently trade at roughly 10 to 12 times forward earnings, reflecting a deep discount relative to many US media peers. Revenue growth has been modest, generally mid single digits, while operating margins are constrained by legacy content costs and large debt servicing. The company's free cash flow generation has been positive, but fluctuates quarter to quarter because of debt repayments and elevated content investment. What the market appears to be pricing is continued margin pressure and uncertain growth from direct to consumer segment. The mispriced risk here may lie in the market's valuation of the company as a fading legacy media asset. If streaming margins begin to expand and the balance sheet can be meaningfully delevered over the next 12 to 18 months, the enterprise could re rate closer to peer multiples of 15 to 17 times earnings. On the other hand, if streaming media growth remains tepid and the debt turns out to be a heavier drag, that discount could persist or even deepen. So, Warner Brothers Discovery remains a leverage and margin durability story. Our second company is Kraft Heinz. Kraft Heinz has seen its stock trade in a wide range over the last several months as investors debate execution versus structural change. The stock trades at approximately 10 to 15 times forward earnings and has traded as low as 10 times forward earnings, which is relatively low for a large cap consumer staple. Revenue growth has been modest in recent quarters, generally matching overall industry trends. Operating margins, while respectable, have been pressured by cost inflation and higher marketing spend. Free cash flow generation has been solid, though not spectacular, largely due to working capital normalization. The market today seems to be focused on low organic growth expectations and limited upside from the existing brand portfolio. But the mispriced risk here could be tied to Kraft Heinz's ability to streamline SKUs, cut costs, and unlock better margins without necessarily splitting the company apart. If execution on productivity initiatives show tangible results, the forward multiple could expand towards the low 20s. Conversely, if competitive pressures and retail trade downs intensify, the current valuation may even look generous. So, this is a margin execution and optionality story. Our third company today is McDonald's. McDonald's continues to command attention as its value promotions have driven renewed customer traffic. The stock currently trades around 24 to 26 times forward earnings, supported by consistent revenue growth in high single digits, improving operating margins in the mid 30% range, and robust free cash flow conversion. What the market appears to be pricing is a durable defensive franchise with resilient sales and strong brand pull. It assumes McDonald's retains pricing power while managing labor and commodity cost pressures. The primary mispriced risk may be on the positive side. International recovery and digital ordering penetration could drive incremental operating leverage that isn't fully reflected in current consensus estimates. If international same store sales growth accelerates and digital channels continue to capture market share, the multiple may expand even further. On the downside, though, prolonged value promotions could compress margins more than anticipated. So, McDonald's remains a traffic resilience and margin leverage story. Our fourth company is a European company, Hapag-Lloyd. Hapag-Lloyd's headlines have been dominated by its agreement to acquire Zim Integrated Shipping Services in a deal worth approximately $4.2 billion. The company operates in a cyclical container shipping environment, and freight rates have normalized from pandemic highs. Hapag-Lloyd currently trades at around 8 to 10 times forward earnings, reflecting both cyclicality and investor caution about rate volatility. Revenue growth tends to be tied closely to global trade volumes, and operating margins can swing widely with freight rate fluctuations. The mispriced opportunity may lie in the durability of scale advantages. Should freight rates stabilize at higher levels than the current trough expectations and the integration synergies materialize faster than modeled, the market could be underestimating future earnings power. The key risk, however, remains a global trade slowdown that suppresses the rates and contract margins more than expected. So here we're looking at cyclical earnings and scale realization story. And the fifth company is Siemens Energy. Also in Europe, Siemens Energy shares have rallied considerably in the last year, growing almost 125%. Currently trading at 75 times earnings, recently Siemens Energy has been a subject of investor debate as major shareholders question the timing of potential wind unit spin-off. Operating performance has been mixed. Gas turbines and grid segments remain reasonably steady, but the renewable side, particularly wind, has experienced execution challenges. Revenue growth has been robust with a guidance for 11 to 13% in full year 2026, while margins have struggled under project delays and cost overruns. What the market seems to be pricing is persistent execution risk in renewables and weak near term visibility. Currently, Siemens Energy trades nearly 30 to 49 times forward earnings. There may be a mispricing here on the base industrial business, particularly gas and grid, which could deliver more stable earnings than current narrative credits. If backlog quality improves and earnings in these segments strengthen, the shares could rally. Conversely, prolonged renewables setback would compress the current valuation. This is truly a strategic execution and segment mix risk story. And finally, we have our Asian pick today, Alibaba. Alibaba has been in the news recently when it unveiled its Quen 3.5 AI model as it pushes deeper into agentic and enterprise AI applications. The shares trade at roughly 15 to 17 times forward earnings, a discount relative to many global technology peers, largely due to lingering regulatory concerns and macro uncertainty in China. Alibaba's revenue growth is closer to 10 to 15%, with cloud computing a key long term growth driver. Operating margins have been under pressure as the company reinvests in AI and international expansion, while free cash flow remains positive. The market appears to be pricing in both regulatory risk and slower near term growth. The mispriced risk could be that cloud and AI revenues scale faster than expected and regulatory clouds begin to clear, driving multiple expansion without a dramatic change in fundamentals. On the other hand, persistent macro headwinds or renewed regulatory scrutiny could maintain the valuation discount. So for Alibaba, the theme is technology growth optionality versus risk premium. That concludes our today's daily shareholder brief. This program is for informational purposes only and is not an investment advice. Always do your own research, consider your individual financial situation, and consult a professional before making any investment decisions. I may own some of the stocks discussed in today's briefing, and ownership could bias my interpretation, so please take that into account. Join us tomorrow morning for another structured look at the companies shaping the global markets.